Awesome.
Welcome, everyone, to this fantastic webinar to celebrate the International Day of Education. We have a wonderful panelist whom we are going to very shortly introduce. But before we do, let me start by acknowledging that I'm coming to you today from the lands of the Wurundjeri people of the Kulin Nation, and I take my opportunity to provide my respects to their elders, past, present, and emerging. So the topic of education that we're going to look at today is one that's not often top of mind when people talk about education, because this is all about financial education. And a really important aspect of education in Australia, because I think the latest surveys show that almost 40% of adult men and more than 50% of adult women do not understand basic financial concepts in Australia. So this really impairs their ability to make informed decisions about money, which also has impacts for the economy as a whole. So without much further ado, I might hand over to Anna to kick off this wonderful panel with Lacey.
Thanks so much, Benita, and definitely really excited to talk about, well, to get into this topic today. I think financial education is something that is often, it's a really important area for us to be talking about. And I think Lacey will give us a really good context and perspective in terms of why this is something for us to be thinking about. But in terms of, for those of you who haven't met Lacey before, with us is Lacey Filipich, who is the founder of Money Schools. And I'll hand over to Lacey to introduce herself in more detail and tell us more about Money Schools and also why financial education and wellbeing is something you think is worth talking about. So I'll hand over to you, Lacey.
Thank you so much, Anna and Vinita. What a delight to be with you. And I'm coming to you from Walyalup, which is on Noongar Budja, over in Western Australia, the lands of the Whadjuk people, and feel very honoured to be here. It's beautiful. You're welcome to come visit anytime. We have lots of beautiful beaches and sand over here, and thank goodness the traditional custodians looked after it so well so that we can now enjoy it. My story actually starts as a chemical engineer, which is not what you often hear in financial education. But I was early in my career, I think I was in like year six of working, when I had a quarter life crisis and I quit work. And my friends all said, Lacey, how come you can quit work? Don't you need money for like rent and food? And I was like, oh, have you guys not been saving or investing? And they were like, No, we've got credit cards and car loans. And if we stop working in a month, we would have to move back in with our parents or something fun like that. And that was the first time I realized that I had just won the ovarian lottery, getting my mother, who was an accountant, and she taught me about money. And so that's where my journey into financial education began with this. Oh my gosh, people didn't get taught about this. I thought everybody did because I learned about it at home. And my amazing mother, who was my co-founder, Fran White, started teaching me about money when I was 10. So that's when I started saving. I started saving half of every dollar I've ever been given or earned. Started investing when I was 19 and reached financial independence when I was 31. I wasn't actually financially independent yet when I had that, quarter life crisis and stepped out, but I was on my way. And because I had savings and I had investments that were paying me, having to work was starting to become less critical. I could take big breaks. And I was starting to see how that affected my life choices. And I really wanted people to understand the things that my mum had taught me, because what I had seen was none of it's super complicated. It's made to look quite complicated. Some of it sounds really complicated because of the jargon. But the principles are actually quite straightforward. And if we can give people some knowledge, then they can start making choices that are going to set them up for a better future. So that was my goal. And I dragged my mother along for the ride. And in 2010, I forced her to co-found the business Money School with me. And we became financial educators. So it's 15 years now. And at the time in 2010, financial education was not really strong in the curriculum of schools. But then in 2011, the next year, it got embedded really heavily. So whenever you hear someone say we don't teach it in schools, actually we do. We have been for 14 years. We just don't do it very well at the moment, which is why you can be forgiven for thinking that. And I thought my job would be done very soon. I thought, oh, well, we're getting it in schools. Young people are going to come out. They're going to be financially capable. Our financial capability actually went backwards. Our literacy scores declined. So we're not doing a great job yet. So here I am 15 years later, still teaching people about money, and the mission is not done yet. And I've learned a lot, obviously, along that time.
A great introduction. I think it's a good point that, even you can learn things, the fundamentals in school, like potentially I remember learning about tax and compound interest, and you're kind of learning it in the context of studying. Like you're not learning it, you're not necessarily thinking about how this relates to me. I'm just thinking about passing the exam and ticking off the curriculum. And when you're in school, you kind of memorize stuff and then you forget it once you walk out of the exam room. So I think it's interesting to think about, even if the fundamentals are there, is it contextualized in a way that actually makes people think, oh, this is what I should be doing, or this is how I should be managing my finances. And yeah, keen to definitely hear more about some of the learnings that you've gained over this time, because 15 years, there's a lot of things that have changed, technology, very different landscape, I imagine, in terms of what schools are teaching, how they're teaching it, the level of access as well. But I'd love to know, as a starting point, what has been your journey over the last 10, 15 years from when you became a financial educator and when you established Money School, and kind of what you've seen along the way?
Well, I think probably the biggest one is I started out in 2010 with this very strong sense of personal responsibility is important. Making good choices is important. And a lot of this belief, and I guess I'd been raised that way, that your future is yours to create and anyone can do it. And you just need to know the rules and you need to know how it works and then you can go. And I guess about halfway through, so I'd say probably 8 years in, I really came to be aware of how big systemic pressures are and how it's very unfair to place this personal responsibility on some people. So I'd say philosophically, that has been my biggest change. I still teach personal responsibility. I still teach making the right choices and doing the best you can. And I always say, we've all been dealt our hand of cards. You got to play them the best you can. There's no excuse for not trying. However, I now contextualize that with, hey, there's lots of systemic pressures. And if something has been fighting against you, please don't blame yourself. I guess I try to get people to be gentler with themselves these days. I'm much less on the, hey, it's your fault, and much more on the, hey, so long as you're trying, you're doing the best you can. If there's systemic stuff, we obviously need to do everything we can systemically to change some of these things. We won't be able to fix, for example, poverty in Australia without systemic reform. We need to raise the rate. When we talk about welfare and Centrelink support, we need to have systems and processes that help people, that don't drive them into detrimental forms of debt. Without that, it's really unfair to hold people personally responsible. And I think that's probably been what I have learned through working with like a wide variety of clients. Like I work with everyone from, high net worth, private wealth network type people, all the way down to people who are like long-term jobless, struggling to make ends meet, sitting on the poverty line. And when you see that full range, it's very hard to stick to that it's your fault line. So that's probably the biggest one. I think the other thing is when I leapt in 2010, financial educator wasn't really a thing. Like the Barefoot Investor was writing a column and appearing on TV, but there wasn't a title called financial educator. So we knew we had financial advisors. And it took me a long time to learn about financial counselors, who are probably the more important, sorry, financial advisors, but the more important people in our ecosystem. So understanding those two roles and how the legislation plays out and how they're controlled has been a big part of it. And what I've come to realize is, of course, financial educator is a completely made up job title. Anyone can call themselves a financial educator in Australia. I've just called myself that because it's the best description. We don't legislate for it. The closest we've got is in the Australian Securities and Investment Commission, ASIC's legislation. They talk about you have to, if you're going to do what I do, deliver financial education, it must be balanced, fair, and factual. They're the three things. And so I'm very strict on that with myself. I make sure that I stick to that. But a lot of people come into the financial education world with really good intentions, but they don't actually know the full story. They don't know, they might know about ETFs, exchange traded funds, but they don't know about listed investment companies, LICs. And so it's very hard to be balanced, fair, and factual if you don't know the full picture. So I guess over that time, I've become much more conscious of my need to stay up to date with what's happening in the ecosystem, understand all the legislation, and definitely to call on experts when I need to, particularly accountants regarding tax. I'm very cautious about how I comment about those things if I haven't checked them through my accountant first.
There's a lot that I want to respond to there. I think the first one is definitely, it's such a great learning when you realize that education alone can't fix things. If you put if you put personal responsibility on everyone, it becomes this almost entitled perspective of, well, I did it, everyone else should be able to do it. And I think that's such an important learning that a lot of people misunderstand. It's kind of like you don't choose where you're born. You were born with a mum who's an accountant. There's plenty of people who weren't born with mums who are accountants, and it's no one's fault it's a really important distinction that I think helps when you recognize that. And I imagine that's why you're quite, very good at what you do, because you're recognizing that every single person has a different circumstance, which is really important. And the systemic barriers, they change as well. What was the biggest challenge in 2010? There's probably those plus new ones that have been exacerbated by the pandemic or exacerbated by technology, or there's probably all these new things that change. The other point is anyone being able to call themselves a financial education sort of expert, and you get finfluencers and people giving advice who potentially aren't doing that first part of recognizing that everyone has different scenarios and having that kind of, well, I could do it, therefore everyone can. And if you're not doing it, you're doing something wrong, which I think is where it gets really unfair, because you kind of place the blame on people who actually weren't given the same opportunities as other people. I'd be interested to know if there's anything that you think has been any of those systemic barriers that you've mentioned. Are there any that you're noticing are increasingly challenging, or any that you're noticing? You mentioned, say, joblessness. Are there any
Mhm.
things that you are noticing are adding pressure onto, improving financial wellness, financial literacy, financial independence?
Oh, absolutely. There's been some really big trends, especially like in my career. I started working in 2004 full time. So it's, 20 years now. Job security is a massive thing. The casualization of the workforce, this whole, we're going to all be, side hustlers now. We're all going to run our own business and not have this secure employment. I think is hugely detrimental, particularly for young people. I was lucky that I graduated with an engineering degree into a mining boom and I could make a lot of money early. That's what got me to financial independence. It's also that I didn't spend it, I kept it. But I couldn't have done what I did without that job security. I couldn't have invested the way I did. I was 19 when I got my first mortgage. I at the time it wasn't hard. I can't see too many 19-year-olds be well set up to do that. There certainly can, there are certainly people who can do that, but it's harder these days. And so I think that's the first thing that's been a big issue for young people, particularly. How do they get that, great experience that's going to set them up to make big incomes later, because your income is the biggest determiner in whether you're going to get to financial independence or not. I think there's also cost of living and housing affordability has been a big pressure for people, and that has certainly exacerbated in the last 2 decades. That there's no question in my mind that housing is less affordable now. And yes, even with 18% mortgages, so anyone who's going to argue with me about that, it is harder to afford a house, even at 5.5% interest rates, which is our current average, versus when it was 18%. But you only had to pay 3 times your annual salary for the house. The problem is how much more we have to pay for the house now has a bigger impact than the interest. And yes, you did tough times, but it's harder now. So I think there's those external pressures. And the second thing, of course, is the rise of technology. Oh, sorry, they're probably on to the third, aren't I? The rise of technology. We get marketed to constantly because of these things now, like you got them in your pocket. They're constantly telling you to buy this thing. And we've made purchasing frictionless, and the introduction of new purchasing methods such as buy now, pay later, which gets thought of as this debt-free thing when it's clearly debt, and people still, end up in dire straits because of it. I think we've made it easier to part people from their money, and that's a pressure that's due to how we've set up our economic system, due to company law. The Corporations Act says that these companies have to try and make money to be able to survive. And that's their highest obligation, more so than the customers. So there's a lot of, sort of contextual stuff that's happened. I think in the money arena specifically, there's also a lot of stuff that's been hidden that's now visible. And I think about, financial coercion and abuse has been pretty key on that. And there's some fantastic work by Catherine Fitzpatrick, who you've probably come across, who's trying to revolutionize how companies prevent financial abuse from happening. So, for example, abusers used to send, 1 cent or $1 transfers and then include a scary message in the text to bank accounts. So those sorts of things that prevent that kind of abuse is becoming bigger. So I think there's some technological advances that are good, and some societal advances that are good. And like I mentioned, financial educator wasn't really a thing back in 2010. Thanks to the Barefoot Investor, everybody knows what a financial educator is now, and we're much more able to talk about it. But those societal pressures and our economic changes are kind of pushing down against that positive movement. So yeah, it's been an adventure. Every time I open the news, I see another scam that someone's fallen for, and they can be the most intelligent people in the world. One of my friends, Yakami Dupree's, lost $760,000 to scammers, and her background is in corporate finance and forensic accounting. People fall for these things not because there's something wrong with them, but because of the way that things have changed. And I think that's the thing that's accelerated most in the last 5 years. And that's again where I think this personal responsibility thing can be misused. We definitely need to be working on these systemic pressures and being very careful and cautious about how we allow changes. You know, buy now, pay later was introduced. It was found to be detrimental. It took several years for the government to intervene and finally legislate it, which happened on 10th of June 2025, and put in the credit code. By then, we had 1 in 5 buy now, pay later users going without essentials like meals to make repayments. You know, so I think we go to first in letting these technologies in rather than making sure they're safe. I've probably gone a little bit off track there, but hopefully you get what I mean. That trend is definitely one that's got my attention.
No, that's perfect. And I think you've made a really good point. There was a webinar we did a couple of months ago where we were talking about home loans specifically, and one of the conversations was about how the banking system hasn't really changed in terms of mortgage processes and how people buy homes, yet you're talking about so much innovation in the payment space. So if it's easier for people to make payments digitally, Apple Pay online, buy now, pay later, there's lots of ways you can buy things, and particularly younger generations who there's a lot of pressure to buy the right things and be seen with the right trends and everything. So there's increasing accessibility of spending money, and then it's also harder to buy a home because of housing prices and the way the mortgage system's set up. It's very hard to buy a home if you're by yourself. Mostly you need joint income. So it's all these different challenges that don't align with the innovation that also makes it harder for people to build that financial independence. And like you said, when you were buying your first home and your friends had car loans and credit card debt, that's not uncommon, is it? That's even now that would be quite common for a lot of people. But there's a lot of opportunity beyond, I guess, just saying, oh, well, if people had more education, it would help. However, there's also a lot you can do with empowering people to understand their financial position. So I'd love to learn a little bit more about Money School and kind of what you think's worked well, particularly when thinking about, I guess, the landscape changes that you've seen. But yeah, what do you think's translating well and making an impact?
This is an area where I've wrestled for so long. Like I mentioned before, we put money really well into the school curriculum, I would say. Now, it's not a discrete subject, but it's across humanities and social sciences in the economics and business stream. It's in maths under the financial maths stream, compulsory from years 1 to 10, right? And I've had a look at it. It's 95% of what I'd want to teach. It's the delivery that matters, and it's the application that matters. So I think what happens is we focus too much on literacy, on the knowing, like I know how this works, and not enough on the capability, which is application, which is basically I do. So I think of literacy as I know, capability as I do. So I try to focus on stuff that's going to make people financially capable. They need the knowledge first, but then I need them to implement it. And because there's a tendency in a lot of financial education to be very rigid about some concepts, like you must have a budget, I disagree. That's not compulsory. Or you shouldn't have a credit card. I disagree. You can have a credit card. It's about using it wisely. If we keep implementing these rules and telling people that there are these absolutes, then they can't find a way to make it work for them. And then they don't do it, which means there's no point. It doesn't matter whether you were right or not. It doesn't matter if you're right that, hey, you must have a budget. If your way of doing it and your way of forcing it on people turns them off, you actually didn't help. You just made them feel guilty or you made them feel frustrated. So most of my education focuses on here are all the options. Lots of choices. Here's how they work. I'd like you to find one that works for you. And so I haven't found too many absolute rules. I try to keep it to just 3. So almost all my education is founded on we must save. So save's the first rule. But there's no number on that, no percentage, no how much. Just you got to keep some money for future you. Then buy assets. So when you've got some of that money saved for emergencies, anything that's excess, you can start investing in assets that are eventually going to pay you. And then avoid bad debt. So that acknowledges that there is good debt. There's debt for investment that can be really beneficial. But if you're borrowing, whether it's buy now, pay later, or a credit card or a personal loan or whatever, there's something that's going to go down in value and isn't going to produce an income for you later, you should try to avoid it. That doesn't mean you can't use it. Like I've said, I like credit cards. Don't pay interest on one, but I really like the fraud protection. They have unbeatable fraud protection for online transactions. You just can't get the same with a debit card, and that's why I will tolerate having credit cards. I just don't pay interest on them. But that's the point. It's not this absolute rule. You don't go out and say, oh, you shouldn't have a credit card. You go and explain how the credit card works, how to use it wisely, and how to avoid paying interest on it, which is the point. Acknowledging the behavioral part, I think, is the big part of this money stuff. We see a lot of people have very rigid rules, but there's a behavioral component. So everything that I teach has an overlay of the sleep well test. I don't care if it is the mathematically best thing. if it's going to cause you stress and you're going to lose sleep, you shouldn't do it. This is no point because you'll make mistakes. The stress that you have will outweigh the financial benefit because you might end up living less healthily, having stress in your marriage. Divorce is one of the most expensive things you can do. So please, do everything you can to make sure that you are doing the best you can. But if there's something that doesn't work for you, that's okay. So that's the other thing I do encourage a lot of is experimentation. Because how do you know it works for you? You have to try. You have to find out. And you don't have to find out with real money. Like you can play things like the ASX share market game. If you think you might like shares, but you're not sure, play with a virtual $50,000 and see if you like it. So that kind of experimental approach and listening to what works for you and what doesn't work for you, I think is really critical. So that's what Money School focuses on. All of our education's like that. Over the years, I've changed my curriculum a lot to different models. The pyramid that Money School logo is, the 5 steps, is actually the original curriculum. It used to start with like save, plan, earn, invest, borrow, and now I do those 3 rules instead. But very much focused on equipping people with skills. I think what I've noticed over time is that the best way to learn these skills, the most effective learning experiences, always involve some kind of interaction. So I love doing live talks and workshops. And I haven't gone into like coaching or like group, sessions yet, but I think I might try and do that because I'm really interested in trying to get more people to actually apply what they've learned. And what I notice is people get a sticking point. They'll learn the concept. They'll be like, oh, okay, I understand saving and I understand I need to set up an automated saving process, but I don't know how my payroll works. Or I'm not sure which account to choose. And there's those little tripping points that stop people from taking action. So I'm very focused on what are those and how do we get people past that. And I feel like coaching works better. But I also have online courses and I have a book strategically placed behind me that's sort of a DIY for people. And I figure whether you get financial advice or not, whether you hire an accountant or not, whether you're going to DIY, the more knowledge you have about how this stuff works, the better your chances are of making a good choice and not getting tricked by a scammer or by someone who tries to pull the wool over your eyes and doesn't have your best interests at heart, which we've seen a lot of, unfortunately, in the Australian ecosystem, starting with the Banking and Financial Advice Royal Commission in 2017. So I feel like education is going to help no matter what, but I'm really interested in how to make it effective.
Definitely. And yeah, scams are something that's such a concern when you think about technology. That's where it probably is making things harder because it's easier to, you talk about, say, friction, and you want things to be easy and seamless, but then the more easy and seamless it is, the more opportunity there is for money to get lost and stolen. And yeah, very challenging landscape that we're in. I'd love to know, when you think about teaching adults versus kids, I think you've made a really good point about accountability. And I think something that really helps with people building financial well-being through capability building and literacy is actually understanding their own scenario. And I think, you kind of made this point about the importance of, say, homework, where I know that it's good to, have good debt and save money and whatnot. But if I don't fully understand my ingoings and outgoings, then how can I really do that? And it's one of those things that, like when you're buying property, it's so painful to sit there and calculate your expenses. It's just the worst because it's so tedious and confronting. And I think everyone would just avoid it forever if they could, because it's always way worse than you think. You spend more than you think and you don't earn as much as you think. So I think that's, once you fully lock that in, you do that and you go, okay, maybe I'm saving slightly more than I expected, or I've got potential to borrow for a home and I didn't realize that I did. Because I think for the average, especially young Australian, they're told that buying a home is not achievable. And I think part of that is it's just drilled into them. It's too expensive. It's not possible. And they don't even realize that it is possible through steps. There's things like LMI, there's things like 5% deposit. There's ways to do it that make it possible if you kind of get that help with knowing what's how to set it up and how much to save and when you could save. And another topic that I'd love to talk to you about in a moment is retirement. But back to my question from many minutes ago was, in terms of the skills for kids versus adults, what do you think makes it digestible when you're teaching either someone who's quite young without that lived experience and potentially the biases of it's not going to be possible for you to buy a home, versus an adult who has probably quite a different experience?
It's a really personal question, I think, for everybody. We're all going to have different takes on this. But I think when I started money school with my mum, we were actually teaching parents how to teach their kids about money. That was the goal. And the reason we wanted parents to teach their kids is because so much of money is about your personal values and your expectations. Like you and I will have different approaches to donating, for example, or how we prioritize spending. And school might not be the best place to learn those things anyway. So I think it's really important to come through a values and principles lens for young people. What is a priority for you? So I agree it's harder to buy a home. I've already waxed lyrical about that. And I agree that it's also possible to do it if you want to. It's about knowing whether it's really important for you or whether you're just taking the advice that we always hear, which I know you must buy your home first before you invest, which is a rule of thumb that you probably heard around the Christmas dinner table from your relatives for years, right? So giving young people enough critical thinking skills to look at the thing, analyze it, and then decide if it works for them, which is about self-understanding in a lot of ways. So I have resisted teaching kids directly, like, young kids and teenagers until about 20, I think it was 2016, when one of my clients, her child needed help with her business. And she said, "Oh, is it okay if my child Ash talks to you?" And I got on the phone with Ash. And after a while, we worked out that Ash at 10 had made $3,000 selling lip balm at her local church. She makes lip balm from olive oil and beeswax. It's amazing stuff. I've still got it 9 years later. She's now like 19, but at the time she didn't know what she needed to do for the business. She didn't understand whether she needed insurance. So she didn't know that she was making a therapeutic good and that has implications. And she wasn't sure how to find markets. And so what I learned through that process with Ash and then with a bunch of other kids is that if you teach them to start a business, you teach them about money. So I actually much prefer that. And you mentioned before, I think, Anna, this contextualization. If you haven't earned your own money, it's very hard to understand. Very hard to understand the importance of understanding where your money is going or how pricing works or like how to prioritize because it's all hypothetical. And hypothetical's nice until the rubber hits the road, until that phone starts pinging and going, "Oh, you should buy this thing on Instagram." Oh my gosh, the targeting, right? So I think the more we can get kids to have the experience of earning their own money and then controlling their own spending and learning from that, the better. And I find getting them to start a business between the ages of 10 and 12 is like the closest I've come to a silver bullet for financial capability. When you get them to calculate their revenue, take away their expenses, and then divide it by the hours work, and they go, "Oh my gosh, I made 52 cents an hour." It's a real, like, they save after that. They understand the value of money. So I think that's really important for young people to understand the value of money, how important it is, and how to make it and how to keep it. So for young people, I like that, anything that encourages them to learn to save and then for the investing later on. I think this question about housing is a fascinating one in Australia. We're behind the world in a lot of places. For example, Europe, where there are much longer term leases. So like you can get decade-long leases. There are people who live in rentals for ages and they have security because they know about it. And we don't do that in Australia. And we haven't had enough construction in Australia for a long time. We've had a building drought, which we are now paying for. Now we have to build fast and therefore it's going to be more expensive. And so this question about why people feel the need to own their own home is actually philosophically quite interesting because it's not the norm everywhere. We're just really fixated on it. So I always encourage people, especially young people, if they want to buy the home, you can do it. It might take time. It might be hard. There's lots of things like you mentioned, the 5% deposits. And the other one worth looking at is the First Home Super Saver Scheme, like FHSSS. So there's a few things like that you can do, but really ask why. So that comes back to this, like, am I buying it just because mum and dad or my family or whoever it might be said, "No, you must own your own home"? Or am I doing it because that's really important to me? Because I do think when you lock yourself into a property, if you're young and you have to live in it and that's your plan, you can't move for work as easily. You can't go on holidays as easily sometimes. There's things that imply that. So that doesn't mean you can't get into the property market. You can't look at, for example, investment property or buying real estate investment trusts, REITs, which are shares. So you buy a share, but it's involved in property. There's lots of ways to be involved in it that don't have to be owning your own home. So how do you know that about yourself? You have to take the time to understand yourself. And that's why I think the family context and being willing to talk about money is really important. So most of my education around kids is parents, please talk. Please explain your decision making. Please explain your mistakes. The best things I learned are from the mistakes that I've made and from what mistakes my mother and my father have made. Like those have helped me not repeat those mistakes. But because there's actually a bit of a taboo still about money, there's a lot of people who'd rather talk about their sex lives than their financial lives, unfortunately. We got to get past that. So I think that's the big difference when I think about teaching, kids and adults. A lot of it's just transparency. For adults, there's a lot of shame. There's a lot of guilt. There's a lot of it's my fault because there's a lot of people on social media telling you it's your fault. I think coming to accept those parts of yourself that are priorities for you and not feeling guilty about them is really important. I'm low cost to run. Like I don't like shoes particularly. They're just functional, but there are people who love shoes. There are other people who really care about their homewares. There are people out there who really want a motorbike or a car. None of those things do it for me. I like good holidays and I like good food. That's my priorities. But knowing that about yourself and not feeling guilty about it is important. Allowing yourself to have some pleasure is really important. So for adults, it's much more, I find, about allowing yourself to break what look like rules and giving yourself permission to do that and not living with a lot of guilt, which is more behavioral than like mathematical, right? So you can see the same sort of thing happens. It's not about this, whether you're young or whether you're an adult. It's not about learning all the rules. It's about putting the rules in context for you and making them work for you. Hopefully, that's not too much rambling. That explains my point. But
Yeah, that's great. And I think there's so many things that I think the ultimate answer is there's just no one size fits all, because like you said with property, we're told that especially Australians are very obsessed with home ownership being the right solution, whereas other countries, like you said, it's just not really. People lease cars, they lease houses, it's not that much of a obsession, but here we're told that that's the success is owning a home, and you kind of tick these boxes. And I think the best thing, like you mentioned, is recognizing what you want to do. If you want to travel the world, then owning a home isn't that practical necessarily for you, because potentially you want to live in different countries, or you want to have the flexibility to rent and live near the water and then live in the mountains and then live in the beach. There's a lot of opportunity you can have when you don't own a home. And you can also own homes that are really expensive and cost you money later. There's investments that are really painful investment properties that aren't going to give you money in the future because they're not in an area that's growing. So I think there's this kind of, you can't assume that this is the correct pathway, because you might be earning differently, different cultural, lived experience, different goals. And I think that sounds like, the way that you're approaching it is figure out, what do you want to achieve? What do you want to do? How can money help you with that? And then some fundamentals, like you mentioned earlier, around, focusing on some good debt and potentially avoiding more problematic debt where it's not going to help you in the future. I think that's just shows that it really needs to be tailored to the person. And I think then you get that buy-in, because if you're actually thinking, well, this is what I want because it suits me, that will lead to more success later than, I bought a home, but I don't want to live here anymore. I'm sick of this area. I want to change jobs, but I'm tied down. And then, like you said, with the emotional, it's kind of, you've got this financial stress that's also losing sleep, and you're losing, potentially it's adding pressure to your relationship and all these other factors that was owning the home really, it's
yeah.
that trade-off. So I think that's really well put and really important to think about. And the other thing that I'd be curious for your thoughts on is just in the Australian context, we have quite a unique retirement product of superannuation, that we're at this point in time where there's people who will be accessing super that, they probably will be, some of the first generations of actually having super and using it and having money that they potentially haven't had in the past. And, a younger generation who are quite disengaged with super and don't really think about it and kind of set and forget and potentially hurt themselves later with things like early access to super or different ways of managing that product. But what do you kind of think when teaching about retirement, or do you have any strategies that you are advising people on when thinking about not just now, but setting themselves up 10, 20, 30 years in the future?
Absolutely. So I think I always talk about financial independence, right? So this point at which work becomes optional. So you can kind of class retirement at any age. Like technically, I could have retired at 31 because the income from my assets was enough that I didn't have to work, right? So well outside the age at which I could access super. That's still 3 decades away at that point. So I think framing it as your priorities is important. But if you can't do that and that doesn't really appeal to you, that super system is there so that you are comfortable in retirement, or at least able to afford what you need to eat and a roof over your head and your transport. And it is a relatively new system. It only came in officially in the 90s in its current form. Although there have been certainly people that have had pensions for a very long time in different professions and that kind of thing. But the first official version of super was, I think, 1992, something like that. And so it is new. And when it did start, it was quite small. It was only like 3% and it was only for full-time workers. And so there's a lot of people who are still retiring today with very little or sometimes no super. There was a shocking stat in Western Australia where I am, I think it was 2017, 1 in 3 women had zero super at retirement. That's horrible. So it's one of those ones where if you ignore it, it's going to be to your detriment later. And it does feel, I think, like you said, it's not front of mind for young people. It doesn't feel like your money. So I always encourage people just to remember that is your money. You are the person who cares most about it. And even if you don't expect to have it or expect to use it later, you may as well make the most of what you've got. If you're getting compulsory contributions, you may as well be making sure you're in the right investment mix for you and that you're minimizing your fees. And I do like everybody at the moment to think about where their money is and what future you're voting for. So, for example, if you're in a traditional MySuper product, the top 10 in Australia funds, their MySuper is their default product. All of you hold fossil fuels at the moment. So you're all creating a warmer environment that's going to mean you might potentially have to self-insure your home and that GDP is potentially going to drop and reduce share prices, which is not sensible, right? That's not really good for us. So you want to be paying attention to what you're invested in and making sure that it's right for you, and that it's right for your objectives. And that can be kind of hard to do for some people with super because it's not very transparent. There's a whole industry whose vested interest is in making it look complicated for you. But once you get comfortable with what your statements are and looking at those things and like, how do I find the holdings for my investment mix? You just literally Google your investment mix and your super and holdings, and it'll come up with a list. And you can look through it and see if you're happy with the companies they've got. And switching your mix should be free inside your super fund. And you can do it once a month for free, usually. I mean, sometimes you can do it more frequently than that. Those sorts of things are simple, low cost, essentially free. It's only when you change super funds, from one fund to another, say you go from fund A to fund B, not the mix within them, that you have a little bit of risk where you need to make sure you pay attention to your insurance, for example. But even that is entirely manageable. And you can vote with your feet. They've made the system easy so that you can move, and so that you can decide what kind of future you want. But if you can look at that now, and check once a year. Just have a look once a year and make sure that the product is still the best product for you and that you're still in the right mix. Then that's going to mean you have more money at retirement, which is going to affect your quality of life. And so it might feel like it's far away, but spending a few minutes once a year doing it now is definitely better than waiting till what we see, which is in your 50s and 60s. And people suddenly go, oh my goodness, I have lost out on so much money because I paid for this high fee product, or I put it all in cash during COVID and I forgot to change it back, or whatever it might be. Don't let that be you. Don't have those regrets. And there are certainly some great schemes through super, such as that First Home Super Saver scheme that I mentioned before, which can help for young people because you can save, I think it's up at the moment up to $50,000, only paying that 15% tax rate on it and pull it out for a deposit for a house. So it can be an accelerant for your saving. So there are still things like that are available through super. But thinking about it in this context of like, you don't know how long you're going to live. You could live to your 80s or 90s quite easily in Australia now. How long are you going to continue to work for? You don't know. You don't know what the future holds. So you may as well make the most of what you've got. And certainly make sure that you are not letting that money just fritter away or dribble away for no purpose for you. You got to make it work for you because it is your money.
Love that. And it's definitely, again, tied to what works for the person. When do you want to retire? What are your goals? And recognizing that goals can change over time as well. So it's, potentially retirement age seems right here, but then something changes, and just keeping an eye on everything. And I guess being engaged with your financial situation, just so you can kind of check in and go, this still works. It doesn't need to be changing funds every year, looking into new home loans all the time. It's just kind of, what are your goals? What works for you specifically? And then again, not one size fits all, because everyone kind of has different priorities and different needs that different products can suit. And you've mentioned some of the work you do, for example, workshops and some of the group training that you've been looking into. Are there any, or what are your plans for the future? What are you hoping to be doing more of? And what are you really excited about for the future, both for yourself, but also Money School?
So I have spent a lot of time in 2025 diving deep into the impact of climate change on money, which I know is not a fun topic for a lot of people. And we all sort of go, oh, yes, that's a problem, but I'm currently trying to afford my rent or my mortgage and my food. So can you please stop talking about it? Like, I know that that's the feeling. But the way I think of it is this is your wealth right now. This is your wealth on 3 degrees warming. It's coming for everybody. And so I'm actually updating all of my education and updating all of my work to reflect the decisions that we make and how we vote with our money. So if everything from where you bank to which investment mix your super's in to which shares you own affects how fast our world is warming. And just by moving your money, which can be free, like moving bank accounts is free, changing your super mix, you might pay a little bit more in fees, but is it worth it to not have the pie shrink? I think so. Those things are really straightforward. So I'm focused very much for 2026 on how to get people to understand where their money is and vote with that money. And I'm not talking about going to the op shop, talking about where you're banking, where you're saving, and your shares are, and where your super's invested. So those are really what I'm going to be focusing on in the future. I don't think that's well understood at the moment. When I talk to people, they see climate change as an environmental issue. They focus on resilience. They don't recognize that our money can help shape their future right now and can slow that down and therefore make us all future rich, which is what I would like us to do. So that is my mission. So yeah, that's kind of like a pivotal change for me. I really only started looking into it earlier this year, and then in May I did an audit of my finances, and guess what? Everything was linked to fossil fuels. So I had a lot of moving to do, a lot of bank accounts to move, had to move my super, had to sell some shares and replace them. But having done that, I've learned, of course, that the impact is massive. So there's another chart using the hand sizes. You know, if you want to recycle everything perfectly, it's about this big. If you want to never drive your car again, it's about this big. If you move your super, your impact is this big. Like it is the single biggest lever that you have to slow down global warming. And so I would love to encourage everybody to do that. So that is possibly out of out of left field for a lot of people, especially given my background as an engineer in mining, and I've worked in fossil fuels, including recently. But it is certainly the thing that I am most focused on now. And I will be looking at how to help people move. And so if that means group coaching, if that means doing more workshops, I am in for it. So 2026 is probably going to be a lot busier for me than 2025 was.
It sounds really important and also really challenging because I think it's, like I mentioned, with young people being quite disengaged with super, I think, firstly, it sounds amazing, but I wonder how do you get people thinking about super altogether, just in general? And then how do
Mm,
you get them thinking about the effort of changing, which requires, again, more research and time and looking into options. And then also understanding, getting through some of the noise around, okay, wait, which ones are actually ethical? This one says that they focus on X, Y, and Z, but they're also doing this. It's just less obvious. And, it's something that I remember years ago looking into some ethical super funds and having some conversations with colleagues who were like, yeah, it sounds good, but I just want to retire with as much money as possible. So, and I think
yeah.
that's potentially the younger audience is the target for this because, there's super isn't going to be something we access in the next
Mm.
couple of years. It's decades away
Oh
compared
yeah.
to someone who's maybe it's a bit late. There's hoping to retire in the next few years, but no, I think that
Mm.
sounds like, especially that chart you mentioned, because I think it can feel a little bit, well, why is it my responsibility to recycle properly when big corporations are making these massive negative impacts? But something like
Mm.
super, which can ultimately be over $1 million in the
Mm.
future, times that by however many Australians, I think that has the potential to make real impact. So very excited to see how you go with this. I appreciate the
Well, just
challenge,
on
but I
that,
think, yeah.
it is definitely, I'm actually looking at people 40 and over because this
Hmm.
is coming in the next 10 years. This is not hypothetical. If you think you're
Yep.
going to be accessing your super in the next 2 decades, this is going to impact you. And this concept of ethical has been really problematic. Unfortunately, I don't use the word ethical or sustainable, like because it's been so hijacked. And it becomes confusing, like you say. So
Mm.
I'm being quite absolute. It's only fossil fuels. We're excluding those from our money. That's the first thing, right? We'll get
Hmm.
onto the other stuff later, but that's the no-brainer. And if you are thinking that it's going to be better for you to make as much money as you can, you have to keep the pie big, which means you have to slow warming. If you choose an option that has fossil fuels in it, it's going to shrink your wealth too. So if you are 40 to 60 years old and you are doing that, you are actually making yourself future poor. So I'm hoping that I can use that kind of language to communicate to people, to get them to understand this because it's not well understood. Everybody goes, oh, but that's ethical investing. That's like a niche issue. And ethical investing is kind of like being vegan or a CrossFit enthusiast, like we all like smile and nod and then we're like, oh, leave me alone, when we hear about it. We're not going to go anywhere near that. Money School is going to be 100% focused on that. You are going to be future poor if you keep going like that. And it's going to hit people who are already in retirement because it's going to be in the next 10 years. This is not far off. So I do want young people to do it as well, but I'm really interested in people with lots of assets doing those moves because they're going to have the biggest impact, which is pretty selfish because I want to be future wealthy as well.
No, that's good. And I think it's a good strategy to actually pinpoint something specific because you're right, it's too overwhelming and you think about trying to
Yeah.
cover everything from tobacco, weapons,
Oh,
all these different
yeah.
things where it just goes, you know what, I'm just going to leave the one that I set up 10 years ago when I worked for a cafe. Like it's just easier to set and forget. So I think the way that you've really honed in on something specific, I think that will make the message really, hopefully
Oh,
more
fingers crossed.
palatable. Yep, no, I'm looking forward to seeing this. But I think that sounds really exciting, really good opportunity for long-term impact as
Mm,
well.
yeah.
And my final question is, it's interesting to think about just roles to play. So there's, you've spoken about schools and education and also the role of parents. So that's a bit of a focus for both the education system and then parents in terms of what they're teaching to their kids. Who do you think has the greatest role to play when we think about financial education and financial capability? Do you think there is one organization or one group that does have more responsibility, or do you think it's sort of shared among a few players?
I think it's absolutely the government. I think the government has the most responsibility. If they were clear about what it was required to be a financial educator and required products and companies to not cause harm through their financial products, we would see instant change. Now, I've said it several times, like you still have to play the hand you're dealt the best you can. This doesn't absolve anyone of personal responsibility. But if the government changed stuff the same way that they chucked buy now, pay later under the credit code, like that was a instant fix. If we did that stuff more, we would see much better change. So we need an ambitious set of leaders in Parliament House. We need them in our state governments as well, and we need them to be making influential decisions quickly if we want to see the biggest change. But unfortunately, we all have to do stuff while we're waiting for that, including choose who you vote for carefully. But we all have to, while we're waiting for those systemic changes, and I think the government is the key player in that. We still have to do what we have to do. We still have to make sure that we teach everybody as much as we can and we help them become financially capable. But yeah, definitely government, please.
No, that's great. I think it really is a good wrap-up point where you've mentioned, individuals have a role to play, parents have a role to play, and it's worth us all knowing, what are we trying to achieve and what works best for us, but also recognizing the systemic barriers that mean that not everyone has the same, it's not a level playing field by any means. And, for some people, there are a lot more challenges to do, avoid bad debt or buy a home or, have employment that leads them to a more robust retirement later. There's lots of different things that make it challenging, but I like your comments there about the government and some opportunities that could just speed things up a little bit. Could just make things a bit easier if you look at some of those barriers first, rather than, well, if everyone's educated, then everything's fixed. But tying in, giving people the tools to then be capable to then figure out what works best for them. So really appreciate all the perspective that you've shared. I'll hand back to Vinita to summarize our discussion today, but just wanted to say thank you for such amazing perspective and conversation today.
Oh, thanks, Anna.
Absolutely spot on, Anna. Lacey, that was really fascinating. Lovely to listen to all of your insights, your stories, and your very, very clear, short, sharp messages which people can take home. I love the fact that you've recognized the importance of the ecosystem, that the individual and the environment and the interaction between the two is what determines what happens to that person. So every layer of that ecosystem, including, the government, which is about the third or fourth layer, has a role to play in supporting the individual, as does the family and school as well. So I really love that ecosystem approach to health and well-being, with the interaction between the individual and the environment. I also love the fact that you've distinguished between literacy, which is about knowledge, and capability, which is about what you do, because everything that Anna and myself have tried to talk about for almost 20 years now, in my case, has been about shifting from literacy to capability, because literacy by itself will not get you, the change that you are obviously trying to get people to integrate. And I love the fact that you've recognized that financial education is actually about behavioral change and the impact that your financial decisions have on your physical and mental health, and the importance of the interlink between them, because that again is another big trend that we are trying our level best to explore from all aspects. So it's so good that you're including that into your education as well. And I absolutely love your focus, your laser focus on climate change and money. It is an area that has not been explored, Lacey. So I think it gives you a real platform to be able to explore and engage not just the young people who are interested in it. I love the fact that you're going to be talking to the older adults, because the decisions that they make will influence their future generations as well as their own wealth. So I really end this webinar thanking you so much for giving us your insights so that we can all become future rich. Thank you, Lacey.
Oh, thank you so much for having me. It's been a delight. Really appreciate it.
Thanks very much.